Hey, what's going on guys? It's Aaron from Market Alert, giving you your daily market alerts for stocks. And today I'm here to tell you to not sell your Netflix stock based on the earnings report last week. And you might think I'm crazy, but hear me out. We all have heard that the earnings report last week, and we all saw that the shares of Netflix completely tanked after an amazing gain leading up to it. So why hold on to a failing stock? Let's find out why. But before we get into it, if you liked what we do here, smash that like button and be sure to hit the subscribe button too. It really helps us with the YouTube algorithm and to get these videos out to you guys. And don't forget to comment below your thoughts on if you're going to hold on to Netflix or move on to something bigger. Alright, let's get into it. Purely from a trading standpoint, it's terribly surprising that Netflix dipped on Wednesday. Netflix released the first quarter results on Tuesday after the close, and Netflix stock had roared in the report, gaining over 40% from March lows. Amid a worldwide shutdown caused by the novel coronavirus, investors expected massive subscriber counts. Though Netflix delivered, the parabolic rally into the release set up a classic sell the news event. However, from a long-term perspective, Wednesday's decline is just a blip. Streaming video is a massive market that's going to grow for years to come. Simply put, it's a mega trend. Netflix's demand is going to be resistant to any short-term recession worries, and the subscribers added during this crisis are unlikely to leave once the normalcy returns and the economy picks back up. Though investors sold off Netflix following the Q1 release, the quarter is in fact confirmed the long-term bull case. On its face, the Q1 report looks modestly disappointing. What is close to a worldwide shutdown seemingly would be a positive for Netflix, yet the company actually missed Wall Street's estimates for earnings and narrowly topped revenue projections for the quarter. But as always, you guys need to look a little bit closer as investors. The first quarter shareholder letter gives important context to the broader numbers. The company's response to the pandemic hurt profits in the quarter. Netflix incurred a $218 million in short-term losses, which hit operating margins by 3.8 points. Excluding those costs, operating margins would have come in a whopping 20.4%. Meanwhile, the stronger dollar had a significant hit on revenue, and many newly acquired subscribers only were paid users for a brief portion of Q1, if at all. This is a strong report for Netflix, and I focus on a key metric. The company closed the quarter with over 182 million paid subscribers. Disney Plus, the new streaming service from Disney, just cleared the 50 million mark. It's difficult to see this report as doing anything but confirming Netflix's lead in streaming. Of course, stocks are about more than just numbers, but the company's nimble response to the current crisis shows that investors who own Netflix stocks are owning a quality business as well. After all, Netflix faces an unprecedented situation. It's dealing with a tremendous load on its servers. Usage was so high that the European Union asked this company to moderate its network traffic. Netflix did that so quickly and with little apparent impact on the user experience. That says something about Netflix as a company. Post-production and animation efforts continue as many employees are working from home. There's definitely going to be some impact on Netflix's state, as discussed in the first quarter conference call, but Netflix still should have significant content arriving over the next few quarters. That will only add to the company's competitive edge. The novel coronavirus pandemic is disrupting business worldwide. Not every business can handle the added pressure. Netflix seems to be doing it masterfully, and that too matters most to Netflix stock. Netflix management did admit on the earnings call that subscriber growth may actually slow in the back half of the year. As CEO Reed Hastings put it, subscriber growth was essentially a pull forward for the rest of the year. Subscribers that otherwise might have joined in September instead signed on in March. But that's hardly a problem for Netflix. If anything, amid the streaming wars, it's a huge advantage. AT&T's Unit, Warner Media, and Comcast are launching their own services soon. In the meantime, Netflix's lead will only get larger. And at this point, it's fair to wonder how Netflix can lose subscribers. Even in the short-term recession, Netflix's bang for the buck is significant enough that customers aren't willing to cancel. If anything, the spike in unemployment will accelerate cord cutting and create an even larger base for potential users. This is going to be a defensive business moving forward. Its profit margins are impressive. Netflix still expects full year operating margins to clear 16%. Some skeptics have worried about cash burn as the company builds out its content, but cash flow was positive in the quarter, and Netflix reiterated its guidance that 2020 will be a peak burn, so to speak. Again, investors should look past the numbers as well. This crisis is only going to accelerate the transition to streaming video. And though a case can be made for Roku and other names like Disney, Netflix stock seems to be the best play in the transition. It's a fast-growing, profitable, and well-managed industry leader. Investors can't ask for more than that. Well, there you go, guys. My thought on why you should not sell Netflix. Thanks a lot for tuning into Market Alert. If you like what we do here, be sure to hit that subscribe button. It really helps us to get this content out to you guys. And I'll catch you guys on the next one. Cheers.